Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today we have a returning guest. It is Dave Skarica of AddictedToProfits.net. So thank you very much for coming back, Dave.
Oh, no, it's really good to be here. And it's definitely interesting timing right now in the markets.
Yeah, and it looks like that sector rotation is maybe about to happen here where we go from risk off to risk on because hasn't the stock market, in your opinion, Dave, has the stock market been going up a lot because of fundamentals, or do you think it's other reasons?
I think it's purely money printing. That it's almost like, the three bears thing, like this one's just right, like it's not too hot, not too cold, where the economy's had slow growth, but it's slow enough that the Fed can keep printing money into the system. And it's strong enough where you're not flatlining or in a recession. So then that's the perfect scenario where, maybe a flat to slight revenue growth in most companies' balance sheets and income statements, and then they can borrow at 1% because of ultra-depressed corporate interest rates, which is, of course, related to the rate on the Treasury bill, which is also ultra-depressed. And then you had a lot of, austerity in Europe. You have slowdowns in Asia. You had kind of like this smash in the gold price. It was like the stock market became the only game in town, and you just had a huge amount of momentum flowing into it. And I think what's really interesting right now, and you talked about the risk-on thing, is that what makes it so different from 2007 is in 2007, everything was kind of in this big liquidity bubble. Commodities spiked, emerging markets spiked, alternative energies, which were seen as being economically competitive because of the high prices in oil, they spiked. Everything, every asset spiked. Housing, obviously, peaked in about 2005, 2006. And now we see the S&P going up and some of the other larger first world markets like the DAX and FTSE going to new highs. But we see commodities trending lower. We see emerging markets lagging. We see gold and precious metals, have made multi-year lows on the stock prices as of late. So we're not seeing everything go on this risk-on trade. And this is the first time I can remember since the early 2000s where people are very negative on commodities, but very positive on equities. So that tells me, I think we're setting up, I've always believed, I guess in kind of it's my own mantra too, but I guess the stuff that Peter Schiff kind of talks about, like not everything he says, but the kind of basis that when we do finally get a bust in the U.S. stock market and economy, it will be linked with higher inflation and a lower dollar. And it looks to me like that trade, where the dollar goes down and asset prices go down and bonds go up in yield and commodities go up, that stagflationary kind of trade might finally be beginning because of the shift we saw recently where just everybody was moving into stocks. So remember, when there's only one game in town, and that happened in the late 90s in tech stocks or the mid-2000s in real estate, that's when things get really, really dangerous. So I would think that right now we're kind of in this big topping pattern for the equity market. We're in a big bottoming pattern for gold and precious metals. And also, like in a lot of alternative energy and solar sectors and even some commodities like the coal sector, we have really extremely cheap, depressed companies, which, you know what, they weren't affected by the market upturn to the upside. So I don't see why a lot of those companies would really tank with the market to the downside if we saw a bear market in the S&P 500.
Yeah, if I could add some comments on the general stock market, it looks like a debt for equity swap here in a lot of aspects. You're seeing that where a lot of the debt gets moved to the government balance sheet from the corporations and the private sector. The private sector is getting a humongous amount of artificially low interest rates and debt to take that. You look at a company like Intel, and I think they borrowed more than $5 billion to buy back a humongous amount of their stock. That's money that they're not investing in research and development or anything like that, and that's going to, because they're buying back a lot of shares, that's going to move the earnings needle higher, but it's not going to grow productivity or create jobs or anything like that. And you made a really interesting point, Dave. You talked about all the money and all the liquidity sloshing around. None of it really, especially in the developed world, in the U.S. and Japan and things like that, all this money that the central banks are printing, it's not going into the real economy for the most part. Now, some of it's going into, like, the home builders, some of it's going into the banks, but they're not really, making the loans to small business or entrepreneurs or anything like that to grow productivity. and grow, get us back on a recovery, that money to me looks like it's being speculated with on existing stocks or commodities and traded or shorted or things like that. Is that what you see?
Yeah, I think that's exactly the point. And the one point I've made where, I believe this is kind of a false recovery, kind of like the we've talked about it actually off air, like the 33 to 37 bull market or the 74 to 76 bull market is because of that, because we're not seeing real strategic investments. We're not seeing employment growth. We're seeing just based on cheap money and zero interest rates. And that's why I'm very, very wary. And people have to remember, even though you're in a secular bear market, if you look at the market in the 70s, the S&P went to new highs in 1970, 74, and 1980. And you were still in a secular bear market, meaning an underperformance of stocks on an inflation-adjusted basis until 1982. So there's no reason you can't see the S&P, went to 1687 at the top. It could even go to 17 or 1800 and still be in a secular bear market. Because what you have to understand with secular bear markets, it's a long period of underperformance. And I still think we're seeing that right now. There's no top line growth in revenues, and there's no real structural change in the economy. And the one thing what I find interesting is I'm a little more bullish, say, on some of Europe than some other people. I think actually Europe's big problem could be demographics going forward. But in terms of the short to intermediate term,
and stupid politicians like in France, who are raising the taxes.
I agree with France, but I think as a whole, go look at actually the trade numbers in Spain and Italy as recently. Mm-hmm. They have expanding trade surpluses. So they're taking on the German production model, and Europe has huge social welfare programs.
Their labor's cheap now because there's a lot of unemployed men in my age demographic who are willing to take a lot less salary in order to have some money coming. Yeah.
So you have that going on, and then you have structural reforms going on in a lot of those economies. Like Greece is having huge structural reforms. Now, obviously, they're not going to become super capitalistic overnight, but I think actually there's a lot of positive undertones. And while the European Central Bank wants to weaken its currency, like all these central banks does, they're not quite as aggressive as the Americans or the Japanese. I always tell people, despite all this bad news we've heard about Europe, that it's going to collapse and it's finished and this and that, the euro is actually, as we're speaking today, up a lot today, and it's almost 132, despite all this terrible news coming out of Europe. And if you actually take the deficit as the European Union as a whole, and a lot of this is just because of Germany kind of subsidizing the rest of it, but the actual fiscal deficit and current account deficit is way smaller than the United States if you actually take the entire union together because of the northern countries kind of acting as a buffer. So I actually am kind of bullish. Now, this is a long-term, being from Canada, and Canada went through a period of austerity like this, of kind of modernizing the economy, getting a little less socialistic. That takes a long time. That can take 5 or even 10 years for those reforms to really pay out. So you might see the European stock markets underperform for a number of years still, but I think you're kind of in this big bottoming phase. And the last thing is, because we were talking about this off air too, a lot of these hedge funds who do computer programming trading, they just shorted a lot of European stocks because they're in Europe.
Yep.
But what you've seen,
It was indiscriminatory. Yeah, there was no looking over which one has this much percentage of revenue exposure to Europe, which one has almost no exposure but is based in Europe, and maybe they moved out all their operations.
Yeah. So, but what you've seen is like the telecom companies and a lot of these companies, got pretty stable earnings, but their stocks are down 50, 60, 70% from their highs, and they have single-digit PDEs, and everyone talks about dividend investing. These stocks have 5 or even sometimes double-digit, 10, 15% dividends, and they're not really cutting them. They're maybe not going to grow them because of the lack of growth on the top line in the short term. So I really see a lot of opportunities if you're very selective in those markets as well. And again, the whole thing where the toppiness looking of the stock market in the United States scares me. You could think that they're going to drag some European debt markets down with it, but again, you look at the markets like Italy, Spain, and Portugal, which are anywhere from 60 to 80% off their own all-time highs. You think to yourself, well, if they weren't taken up in the rally, why should they be taken down en masse in some huge decline? So I think there's a lot of opportunities, personally, and even in the U.S. markets, again, like coal sector, solar sector, on pullbacks. shipping companies. These are all really, really beaten up sectors, and you can be very selective. And I actually don't think it matters what the S&P does. I think those things will really do well going forward. And that's why I find today's market so interesting, as opposed to, say, 2007, 2008, or 99, 2000, when we just have these big bubbles, that you have this big move up in the S&P, but there's a lot of appealing-looking sectors out there. And obviously, the biggest one to me is, something that we talk about a lot, is actually the precious metal sector. You look at something like the HUI, a big base forming between about roughly 250 and 292 to 300. It's about 240 to 250. And if we come out of that base, I think we can start a more substantial rally, maybe take us up to 150-day or 200-day moving average, which would be roughly the 350 to 400 range. So I think that looks like a big bottoming formation happening.
You talked about the maximum pessimism sectors where you still see a lot of value, like coal stocks and shipping and those things. One thing those sectors, a lot of them have in common, is a lot of those companies are either not making money right now, or even the best companies with the best fundamentals in those sectors are barely making any money. And the whole industries, these are not the airlines or the railroads where there's humongous government intervention in those sectors that's destroying those sectors. All the companies in the sector are not going to go bankrupt.
No,
okay, that's just my opinion.
Look,
anyways.
See, this is where it becomes like maximum pessimism, or buying like Tom Templeton used to trade, comes a little dicey, because sometimes you do have to kind of put your toe in the water and just close your eyes. Because when Templeton made his famous trade where he bought 100 stocks trading at under $1 back in the early 40s, a lot of them were.
It was during. Didn't he start buying shares on margin during World War II?
Early World War II, because he figured of World War II, the railroads and the economy and the shippers and everything will start running. His actually best performing ones were the ones who were losing the most money. A lot of them were actually in bankruptcy and restructuring, and they're the ones that ended up being the 10 or 20 or 50 baggers. Were the ones that actually were the most stable companies. They did well, but they were like the ones that doubled or tripled or quadrupled. So the funny thing is, you actually sometimes have to buy, like, the worse the company, the better. It can actually be up, because it's just simple leverage. It's just, and mathematics, that this company, say a company's gone from $20 to $1, a rebound back to $4 is a quadruple. So
yeah, and what most retail investors, they don't have the discipline to do it. They can't control their emotions. If they have a little loss, at the beginning of their investment or their speculation, they have a certain amount of loss. They don't have the discipline to buy more. They'll check the price every day. They just can't focus. And this is something a professional would diversify the risk. Because I bought distressed assets too right after the 2008 crash. I bought some gold and silver stocks and copper stocks too that people said, you should not buy. I bought Lucas Lundin's company and I made 500%.
Well, see,
my
best trade off the financial crash wasn't actually a precious metal company. And I'm talking a large cap trade, not like buying juniors, actually, because my best trade was a junior. But my best trade, like a liquid trade, was I bought Tata Motors, the Indian car company. And it was exactly like you said. I actually remember buying it at $350. And it was right near the bottom of the market in March of 2009. The first day I bought it, I was down 7 or 8%. And then, it turned around, it's $27 right now. So, I think, like, you look at like that, you're exactly right. Like, you have to take short-term pain, long-term gain. And also, I tell people, when you're doing a maximum pessimism trade, when you're trying to average in on a decline like this, please don't try to pick the top or the bottom, sorry. Like I like this. There's a company actually in Spain I like. I'm not going to give it out because I can't. It's for subscribers type of thing. But that's what I've done. I've averaged. I bought some. The stock went down another 15%. I bought a little more. And then it went up 10%. And I just kind of average in a 3, 4, 5 pronged kind of process to kind of average in near a bottom. And then at some point, they usually, if like you said, the company's not going to completely go under, they usually can turn around. And you can't be fancy about it. Actually, one of the trades I missed at the bottom in 2009 was I had a bid in for Ford at $1 a share, and the print low was $1.01, and Ford went to $15 a share by 2011. So that's why you can't.
Do you remember Las Vegas Sands at $2 a share in 2009? And I was just thinking of the fundamentals because I knew it was a solid brand name and that the brand was attractive, and I knew that a lot of the Wall Street banks had big investments. I think the Saudis and Dubai people had big investments in the Las Vegas Sands. Yeah, but that was the positive about that trade when it was at 2, and I almost pulled the trigger on 1,000 shares at the time, and I just didn't because I was looking at the fundamentals of like the U.S. consumer and didn't know if they'd have any discretionary income to go to Las Vegas, and it's just one of those situations where I would have at worst lost a couple $1,000, but I would have made humongous gains going forward.
Yeah, another example of a trade like that was Sirius Satellite. Same thing. It looked like they could go under an 09. Because it was their cost structure. They're actually similar to gold stocks. Yeah, the problem was their cost, because of the Howard Stern team.
And the government interference, too. That it was a monopoly when it wasn't a monopoly at all.
But they were doing the merger with XM. Howard Stern was increasing the listenership, all this sort of thing. And they just had to restructure debt. And it went to 6 or 7 cents. And I remember it doing that. And it was before some kind of holiday, like President's Day or something like that. And I remember I was like, I don't want to buy a Thursday before a long weekend. And then they restructured the debt over that weekend, and the stock spiked from 7 cents to 17 or 18 cents. And I was like, oh, I still kind of liked it, but I was like, no, I'm just going to, whatever. The stock is at $3.50 right now. So like you said, a 20,000 share investment, which would have cost, say at 17, even after the spike, which would have cost
a couple grand speculation.
$3,000 would now be worth over $60,000. So,
and that's how you build generational wealth.
Exactly.
That's how you get rich in the stock market.
You have to do it. It's money that you can afford to lose. If I lost $2,000 back then, it wouldn't have changed my life. So it's money you can afford to lose. You throw it in there, and then hopefully you get these big turnarounds. And really, that's how if you look at Buffett or Templeton or all of these value investors, that's how these guys, Wilbur Ross, that's how these guys all make money.
Distressed assets, yeah.
Distressed assets. Wilbur Ross, by the way, is buying shippers like crazy. I think he's got about $10 billion under management. I think $900 million he's invested in shipping companies. So that's 9%, and I think he's looking to put another $300 million to work. So over 10% of his portfolio is going to be invested in the shipping sector. So I think that's the way you kind of have to look at it. It's Templeton had a great quote. He said he wanted to look for. Someone asked him where do you think things are the best? He said, I don't want to hear that. I said, I want to hear where the outlook's the worst, where it's the dreariest, where the news is the worst. And I really think, that's what you kind of have to do in a lot of these sectors. Actually, one of my trades where I did pull the trigger was I bought Greece last summer because the Greece stock market from 2000 to the bottom in July lost 95%, which is more than the 1929 to 1932 crash. And there was still some value in some of these Greek companies. So I definitely think,
especially the shippers. The Greeks are really good with the shippers.
Actually, the Greek telecom company is where I actually made a lot of money, and I actually bought a gambling deal as well, which has done well. So and the Greek shippers are top tier shipping companies, and no matter how bad the fiscal situation gets in Greece, they're never going to tax the shippers because
that's where all the jobs are, right?
Jobs are, right? So I think again, you look at and the timing can be difficult because let's face it. Greece all throughout 2011 and 2012 was really, really depressed. And for example, the telecom company I'm talking about, HL Toy, Atlantic Telecom, and you might have thought that when it was $4 in 2011 and its high was 16, it was cheap. It went to $1, and now it's $4.
There's been some overreactions, too, in Brazil with the utility companies down there and that they're not going to be allowed to increase their fees. So some of those stocks have just gotten punished, too. There's some really good dividends and good profitable companies down there for Brazilian utilities if you want to take a look at those.
Yeah. No, I haven't looked at those, but that's definitely the type of thing. See, I'm to the point where I'm just about buying pessimism right now. But that's my main thing. Even in the gold market, even though
you don't get rewarded. The thing about buying pessimism, and I've made good money off this too, you don't get rewarded right away. And this is what people don't understand. You're not going to get rich off this in a month or 2 months or even normally 6 months. But in 2 or 3 years, if you're right about the sentiment changing and the fundamentals, improving, you're going to get a lot of money out of it.
Yeah, and I think it's the average over the 2-3 year period. like you said, like if you're buying one of these beat up companies, again, let's just use a simple analogy that was $20 and now it's $2 in the turnaround play, and it sits between $2 and $3 for 2 years, and then all of a sudden it goes back to $8. Well, you've got a 400% gain in 3 years, and everyone will take that because annualized it's 120% gain or so. So
I think it's Wall Street. I think a lot of the reason why people don't do it, though, is because they watch, Jim Cramer, or they watch Fast Money, or they watch CNBC or Bloomberg, and it's all these trading ideas like I made this much money in a month or this much money in a week. And people are so myopic now because of all the mainstream financial media that it's all about this quarter's results or this month or this week, and people don't even think 2 or 3 years from now what's going to happen.
No, and I think that's the real tough thing is that, and like the whole financial industry, like I've actually made the comment that they should change the hedge fund industry to have the performance based on a rolling 3-year basis. So that way you can, you see what I'm saying? Like,
most of these guys wouldn't be hedge fund managers anymore.
So if you did that, they would actually.
I think haven't the majority of hedge fund sorry to interrupt you, but haven't the majority of hedge fund managers for years now, they've underperformed the market, I think, drastically since 2009 and 2010.
Yeah, and part of the reason was I think people didn't expect the markets to go up like they have. It shows you how tough it is just to trade on a day-to-day and quarter-to-quarter basis. So, but anyway,
because you're staring at trees and you miss the whole forest. Then.
Yeah, exactly. So the thing with me is, like I said, I like right now, and as much as a gold guy I am longer term, and how I think we probably fundamentally agree in terms of the printed money, the failure of Keynesian economics longer term. That gold goes significantly higher. I really gotten to the point where now I'm interested in the gold, precious metals, and junior mining sectors. And even a year or two into the rally, and this is where I've changed that because I know a lot of people in those industries and sectors. I would have been, maybe not chasing, but been more involved in the market when it started to get frothier. But this time around, when these markets bottom, I think now is the time to buy them. I'll go maybe as late as 3 to 6 months from now too. But when things get frothy and it starts moving up, I'll still hold the positions I have. But I'm going to be looking for the next sector, which has crashed, rather than be chasing something up in a bull market. But that's really what I'm all about. And if you look at the performance, that's where your best performance comes too. Templeton talked about that too, is that off the bottom is kind of where stocks perform the best because usually there's shorting involved because people are so negative on the sector.
Oh, yeah, I love if you do really good research and the sentiment changes and the fundamentals shift, you can make a ton of money on the short squeezes, yes.
Oh, totally. Again, you just look at something like Apple, which became pretty universally loved, but from March of 2009 to April of 2010, Apple tripled. That was easily the best percentage move of the entire move from 2009 to 2012. So, that's really where you want to get in. You want to get in near the bottom, and if you sell out a little early, I wouldn't really be worried about it because you're always going to have some kind of pessimism trade. Just to end off here, one market you're going to laugh that I'm looking at buying right now, and it's very illiquid, and I'm going to actually have to set up a brokerage account there and I'm just going to start small, like we talked about earlier with the earlier examples, put a few $1,000s into it, is Cyprus, because the Cyprus market has lost 98% of its value. Wow. From its top. So there's no liquidity there. The thing trades like 50,000 euros a day in total of the entire market. But I think it's the kind of market where you can pick, say, 10 stocks, put $1,000 into each of these stocks. A lot of them are just malls and companies that pay big dividends and one or two of the banks and all this sort of thing. And probably if you ignore that 10 grand and come back in 5 years, it's going to be worth $50,000 or $100,000 when that market finally does stabilize after a couple of years of austerity. And just by the way, this happens when Iceland collapsed. Icelandic Air, the national air carrier, went up 10 times in value in the last 5 years since the market collapsed in 2008, 2009.
Those are very interesting points. Let's talk about the commodities bull market because you talked about some of your favorite stocks here. Do you think we're obviously in a cyclical bear in the commodities right now for at least a couple years, really since midway through 2011. But do you think we're still in a long-term secular bull in commodities, or do you think that the bull market has changed a little bit to maybe where some commodities are still in a bull market, or do you think the bull market is over? Because I know from Wall Street now, a lot of Wall Street analysts were starting to hear that the whole commodities bull market is over. Do you agree with that?
Well, from a charting standpoint, say I just looked at the chart of the CCI. I don't like the CRB because I think it's too weighted in energy. So say you looked at the CCI, the Reuters index, which is equally weighted with base metals, precious metals, wheat, and and the agricultural stuff, and it got a whole slew of commodities in there, much more representative of the total commodity market. If I just looked at a chart of that and I didn't know what it was, I would think this is a fantastic consolidation going on from the 2011 high. That we're basically kind of trending lower, we're not collapsing, and then at some point it's getting tighter and tighter and tighter and less volatile, and at some point you're going to break up to the outside. So just from a pure technical standpoint, it looks like quite good to me. And I think people are putting too much on India and China. The India and China economic boom, which really began in the early 80s, but in the 80s and 90s, all the money moved into financial assets, and India and China essentially didn't move commodities up at all, and there was huge demand coming from India and China for commodities. Because that's when actually their economies are both near, especially in the 90s, near double-digit growth. So I think this whole thing with India and China is slowing down, especially with all the monetary stimulus going around the world. That really grinding down commodities is false. And I think that the next phase might be different in what you're talking about, in that it may be caused more of a result of all this monetary stimulus, devaluing of paper money, rather than booming emerging markets. So that's where I think it may change. And again, if you look at the mid-70s peak, the 74 peak in commodities, a lot of the commodities did not make new highs during the 80 peak. I think sugar actually peaked in 74. So obviously you're going to have this rotation, and obviously I think that the precious metals will be one of the commodities which make a higher high during the second half of this move. So, yeah, I think you have to be a little more selective. There's going to be some commodities that do good, some which don't during this kind of next move. But I think on a whole, and I think Bill Fleckenstein said it first, is they said that the first move of this commodities and gold bull market, and I'm paraphrasing a bit here, was really basically from money printing, from 01 to 2011. The Fed printing money, financial crisis, tech bust, and it was just inflating the whole system.
I think also, sorry to interrupt you there.
Move, just to finish here, will be
Okay.
as the consequences from this money printing, which means devaluation of paper currencies, higher inflation, that sort of thing.
Those are great points. If I could add one to your 2001 point, I think China joining the World Trade Organization and starting to provide even more manufacturing capacity, like accelerating it, I would say that really increase their commodity consumption at an even faster rate. My opinion of the commodities bull market is that it's kind of bifurcated to this point. For the one supply-demand fundamentals I really don't like, and I think these are trades only, is base metals. I think those are trades. I don't think those are long-term investments anymore. So if the copper price were to drop below the cost of production, say copper price drops to $3 or below, I would be I would look to start buying, a Freeport-McMoRan, some of the really quality copper producers, because then all of them are going to go bankrupt. None of the copper companies can produce really for any kind of profits below $3, especially the higher cost producers. So that would be something as a trade where I would do it. That would not be a 2 or 3 year turnaround maximum pessimism trade. That would not be a long-term investment for me. But I'm still very bullish because on precious metals, on energy, on food-related stuff, because there's still more than 7 billion people on the planet. We're projected to grow more, and I view food and energy as staples. Those are things people want electricity. They want to heat their homes. They want to drive. They're starting to buy like cheaper cars, like Tata Motors type small cars in developing countries, and people want to drive. So those are the types of things, and then people want to eat, and they're eating more calories. They're going to eat more proteins going forward. So I like those commodities, those supply-demand fundamentals better. There's other select commodities, maybe like rare earths, which are in tougher supply-demand fundamental environments, but they have really interesting supply situations there.
And let's look at some of these commodity prices, okay? Like just in nominal terms, you look at something like wheat, okay? Its bottom in 2010, when it went to $13 a bushel at the top of the commodities boom in 2008, and it went down to just over $4 a bushel in 2010. Actually, that $4 to $4.50 or $4 to $5 range, that was the old ceiling back in the 2000s, 90s, 80s. So the old resistance then became support. So you're right. Fundamentally, in these commodities, we're seeing much higher prices because, like you said, like wheat. Then because they said as these emerging markets develop, they eat more beef. Well, wheat is used as a feed, so it's not just people eating bread; it's animals eating bread because people are going to eat more animals. So it's like this whole kind of like vicious circle as these countries develop. And I think one thing that's going to be increasing for in terms of energy usage is if you look at sugar-based ethanol, it's 6 times as efficient as producing ethanol, sugar is, as corn is. So you're going to have more sugar-based ethanol that's going on in Brazil. So probably you have a long-term uptrend in sugar as well. So you look at these things, and again, you look at corn, you look at wheat, all of their old resistance. Go get like a 40-year chart. You'll see that the 2009, 2010 lows in a lot of the agricultural commodities were actually the old highs 30, 40 years ago. So we're definitely seeing this higher highs and higher lows and that sort of thing. And I think the advancement of these economies as well will kind of help that to play out. Yeah, so in terms of the commodities super cycle, I think you're right. You have to be much more selective. I'm not as huge in the base metals like as you said. I agree with you on that. And I really like you said, I like the grains. I obviously like the precious metals here, especially at these depressed prices, because they're, with all the money printing, they're kind of currency fundamental. So I like a few and handful here. And I actually, from a pure sentiment standpoint, the fact that all of these Wall Street banks who just started talking about the commodity supercycle probably within the last 5 years, who, not even that, I think a lot of them started talking about it at the 2010, 2011 top in the CCI. Now we're saying the supercycle is dead. So I like that from being a contrarian.
Yeah, I agree. And they missed a lot of these guys. There was a few Wall Street analysts like Barry Bannister and some others who called a long-term secular commodities bull market more than 10 years ago. But the majority of Wall Street people have been bearish on commodities all the way up. And they just didn't understand the fundamental thing. They never liked commodities to begin with. Wall Street in general doesn't really like commodities that much because they'd rather sell bonds or stocks or mutual funds.
They're in the business of selling financial assets.
Yeah,
so
exactly.
Why are you going to tell people that we're bullish on, if they're bullish on gold, they're going to be bullish so they can just go underwrite a Barrick bond deal, right? They're not bullish so they can
they'll be bullish for 2 months then, so they can oversubscribe the bond deal and dump the shit.
And the thing that's a joke about all their downgrades right now is go look what all the Wall Street banks were saying in late 2012 about gold and precious metals prices. They all have $2,000 price targets. It was all bullish and all this sort of thing. And now
all their price. Would you agree though that all their price targets are based off technical analysis? So they're trend trading. So when the price has already dropped, they're going to lower the price targets even further lower. And when the price has already run up, the Wall Street banks like Goldman Sachs and those guys are going to move the price targets even higher. And people shouldn't be listening to them on those things normally then.
No, it's all technically based. You're right. Even though, and then they're bullish for their own reasons, even though their price targets are technical. They're bullish because of quantitative easing. And remember, gold went from $250 an ounce to $1,000 an ounce in 2008 before the financial crisis, before we even knew what quantitative easing was. And granted, there was some money printing liquidity added to the markets after the tech bust. But that's what I find amusing about it, that gold already had the majority of its run before these huge amounts of liquidity were even pumped into the system. And it's not the reason that, I think the breakdown in the fiscal structure of the Western world, excess money being printed just, on top of quantitative easing to basically pay for their own debts, real negative interest rates. These are all the reasons that gold is going up. Obviously, inflationary pressures, and gold reflects that, despite the fact they tell us there is no inflation. These are the reasons gold going up. So the guys are bullish, but they're bullish for the wrong reasons.
Yeah, there's not as much. The consumer staple inflation has taken a little bit of a break. It was really bad a couple years ago, and then velocity of money in that sector has slowed down. And, in general, the demand growth from the emerging markets has slowed down too, which also put a lot of pressure on commodities. But almost all the inflation that they printed, a lot of it has gone into asset prices, in my opinion. It's in the real estate market. It's reblowing the bubble there. It's in the bond market, and it's in the stock market. And all these asset classes, except for really commodities, are all rising at once. And one of the main things about finance that you learn is that assets are not all supposed to rise at once. There's supposed to be non-correlations here, and we just don't have that in the markets anymore, which I think is all because of central bank intervention and money printing.
No, I agree with you 100% on that. So, and remember, and this, I guess I'll finish off on this, is that the stock market doesn't really work anymore in terms of, I've always believed what Soros has said, that the market's always wrong, too. I don't believe in efficient market theory. I think that, you obviously go too high during booms and too low during busts. But
people don't make rational decisions in the markets. They rely on greed and fear. And the efficient market hypothesis, I think,
it's completely flawed.
It's BS.
Yeah. But the thing about markets is, during the majority of an upward move, like in the 80s and 90s, the stock market was reflecting a secular uptrend in the economy, and maybe turned into a bubble at the end of it. And it reflected the fact that the economy was a bubble. All these. But now, again, we have this thing where it's not too hot, it's not too cold, they're printing just enough money. So the market is all based on Fed-based liquidity. So it's screwed, like the economy's garbage, and it's screwed the market underlying that. It's based totally on liquidity. And I think we need the next bust to get rid of that. I think in the next bust, it's kind of like Japan right now, where, they've seen this downturn in the market. And I don't know if this will be the start of a major decline, but where you'll see stock prices decline even as they're printing $100 billion a month. And I think that will kind of get the market back to being a little more efficient. And I think that's the problem right now, is that all this printed money has really distorted the way markets have worked. Because, you just want the Fed pumping liquidity into the system rather than stocks and the economy going up on fundamentals. Like if we have a good employment report on Friday, what happens? The market's going to tank because they think the Fed's not going to print as much money. So it's all totally distorted.
Yeah, I mean, the market could tank or the market could go up, and then if the report is really, really bad, the market might go up anyway because the market's anticipating QE. In general, though, it looks like a lot of people are still buying the dip in the market, especially hedge fund managers. But if everyone's buying, I mean, where's more buying pressure coming from? Because look at the margin amounts that are in the stock market right now. Aren't they at 2007 all-time highs for total margin that's invested in the stock market?
We're back at the 2007 highs. Profit margins are actually above the 2007 highs, which at the time were all-time highs. And every time margins have gotten this high, they're completely unsustainable, and the market usually sees a 20, 30, 40% correction. So, I would say that all of those macro indicators tell me we're near a major market top. And the sentiment was off the charts. I don't know if you watched the Ridex ratios, which are a group of funds that you can go short and long the market of. This is a smaller group of funds, but it's a very good ratio. And basically, historically, you've got the ratio at like 40%, which means that about 2.5 times the amount of money is in bull market funds as bear market funds, which makes sense, right? Like people are usually long. But during a market bottom, it would actually go over 1-to-1, meaning more assets are in bearish funds. That happened in 2008. Now the ratio recently hit about 0.27 at the bottom, meaning that 4 times as much money was going to bullish funds as bearish funds. And the last time we saw that ratio was actually, that's even higher in 2007. The last time we saw it was during the 2000 top in the tech bubble. So that's how bullish people got during this market move. And to end off on this point for the market, what's going to be interesting is really the masses until just recently didn't get into this market rally. They were net sellers in mutual funds in 2010, 11, 12. And we just saw this big upflow really during the first and second quarters of 2013. But what I find interesting is that means this has all been driven up essentially by hedge fund computer program trading. And you know what's going to happen when those programs start to reverse themselves. Just like all the hedge funds were buying on the way up, they're all going to be selling on the way down. So we could get a very swift market decline because the masses not being in I think that actually made the sense, like steeper, and it'll make the descent a little steeper as well because all these computers are selling or buying to each other, and then they're selling to each other.
Yeah, and the computers can move quickly from long stocks to short stocks and long gold or long commodities, and that would be the risk off back to the risk on trade. And, one of the other indicators that I watch, too, is the options market. I look for how the calls and the puts are priced because I think with the equity market, a lot of the more astute hedge fund managers tend to use the options market to go into positions first because they don't have to report their options positions as much as they do with their stock positions. So they tend to use the options market to hide and mask large sector rotation moves that they're planning. And, you're seeing Soros, who's normally one of the insiders with the inside information and stuff. He's, one of the top hedge fund managers, but I also think he gets a lot of the inside information. And he started to really just buy up GDX positions, and he's starting to buy GDXJ calls. So I think that's long-term bullish for the gold sector that we probably are near a bottom.
Yeah, and again, look at the kind of price action and those ETFs or those stocks. Like, right now, and my current issue is about like how markets perform after crashes. So we essentially saw a crash in the gold market, and you get about a 2 to 3 month basing period, like up and down retests, that sort of thing. And if you look at like the GDXJ, which is today trading about 1250, the reaction high after the April crash was 1317. You look at the HUI, which is trading at about 282 today. The reaction high was about 292. So we're within a few percentage points of kind of these, and time-wise, we're almost 2 months into the base, so that fits within the context of how markets trade after big busts like that. So it looks like to me that we're about to perform this big bottoming base and start moving to the upside. So, and even myself, I actually have call options on Burack and Kinross to play the kind of these bounces as well, and that's very rare for me. I'm not a big option player, and I just saw the bust that went on and just basically look at, forget the fundamentals, I just look at the two stocks that were the most beaten up that I think could just have nice 30% reaction rallies, 30-40% reaction rallies, and those were kind of the companies I saw. And luckily, if you actually take the percentage gains from their lows, it's probably two of the better performing large cap stocks just because they fell the most. So those are not long-term trades for me, but I definitely think, those are I'm still kind of bullish on them continuing a short-term breakout, and then probably would sell the profits from those call options and look to get into something else.
Yeah, long-term, I agree. I don't think Burack and Kinross are good long-term investments, but no, they have easier access to the debt and equity market, so those companies are going to survive, and it's a good, smart idea to play the balance.
Yeah, like let's face it, like on a fundamental basis, Burack does have a lot of growth, but at 17, X one-time charges, Burack was trading at 6 times earnings, which is unheard of for a gold stock. So for Burack to double and go to over $30 and trade at a multiple of 10 to 15 times earnings is perfectly fine, in my opinion, for the stock longer term. And I think that, we can see that play out.
Well, thank you very much for your time, Dave. We're going to wrap up here. Please tell our listeners more about your book and your newsletter and anything else that you're working on. I think you're working on a fund now. Is that ready for investment yet?
That will probably be ready. I'm trying to launch that for the beginning of the third quarter. Unfortunately, it won't be available to Americans because it's an offshore fund. I may set up some kind of onshore structure at some point, but I live offshore. I live in the Bahamas. So, but yeah, I'm setting up a fund. Sign up to addictedtoprofits.net. I have a free letter there, and we blast interviews like this and other free articles I do. If you actually go to the site, I'm about to post one of my recent articles that I did on why I think the market is topping. Obviously, I wanted a little bit of a lag to keep my my paying subscribers at the inside of this, but sign up for that. I'm probably going to have some kind of special promotion in roughly a month's time for the newsletter right after Independence Day, sometime in July. And, and this is what I do. If you like what I'm talking about and maximum pessimism and kind of the bottom feeding and, I give examples of stocks. Like I said, right now I've actually got an alternative energy in Asia, company in Asia and a media company in Europe, which I really, really like as kind of maximum pessimism, bottom feeding kind of trades. So just sign up. And then obviously when I do my promotion, you can have access to that sort of thing. Or if you are based offshore, you can always, I guess, put some money in the funds when we open it up.
Okay, well, thank you very much for your time, Dave, and hopefully we'll have you on again very soon.
Okay, thanks.